Hello, everyone, and welcome to UBS Trending. I'm your host, Anthony Pastori. There are many questions out there. Are we in a recession? Have we seen a turning point in the markets, or inflation, or even volatility? And the big question, what's next? We're going to discuss that right now with my next guest, Michelle Schneider, Managing Director of MarketGauge.com and a frequent guest here of UBS Trending. Michelle, always a pleasure to have you join us. Thanks for being here today.
Thank you so much for having me back.
So, Michelle, my intro kind of says it all, right? We're all in this place where we're wondering what's next, where we are. And let's speak about the R word, recession. There is debate right now about whether or not we are either headed for one or maybe even in one as we speak. And this is despite, we did get 2 negative GDP readings in a row, which is the typical economics 101 definition of a recession. But there are other indicators that have fared pretty well. We've got non-farm payrolls out there. They're slowing, but they're still growing month over month, and we are right now near record unemployment in the U.S. Also, another indicator, personal income. It's near multi-year highs. So I'd love to get your thoughts on where we are economically speaking.
Well, there's so many gravitational pulls all over the place. I mean, I don't know if I recall seeing a period of time where you have so many different influences, and yet the market itself is sort of staying really tight here with this now decent bounce off of the lows that were established in June. So it's almost like, if we looked at it sort of like it's cloudy with a chance of meatballs, as the movie keeps coming up in my brain, because that's kind of what it's like, right? So right now, let's just talk a little bit about the R word. So even long before we had the politicos coming out and saying, well, we're not really in a recession, even though we're technically in a recession, I was kind of saying that from a different standpoint without any bias other than just speaking what I see, which of course is that we are seeing a slowdown economically. But like you mentioned, Anthony, there are pockets that are still more positive than you would typically see in a normal recession. So that's stagnation, right? And then in terms of actual inflation, we've seen some cooling, although if you look at a chart of the CPI, the core versus the broad, we haven't seen much cooling. But we look at that, there's that out there, but prices have come down. And then you look at the consumer, and the consumer discretionary space really kind of started the ball rolling on this rally. And then you look at the actual earnings, and you have some earnings that were better than feared and some earnings that have just been really much better than what was expected. And then you look at the Fed, and they're kind of like right smack dab in the middle here, trying to enact a monetary policy in a stagflation environment where you also now have the meatballs of the geopolitical risks that are real and all around us.
Right, and as you've written that quantitative tightening is still kind of running in the background. The Fed really does have quite a job ahead of them to get us to be a little bit less volatile and get a little bit more of that consistency we're seeing, despite what the economic indicators will actually show us. So that was a really good way to start off, Michelle, and clearly the recession word will be coming up through many conversations, I'm sure, over the next couple weeks and months. Now on the market side, we're looking at equities, we're looking at fixed income. The S&P 500, after hitting a multi-month low on June 16th, now it's begun to rebound a bit and has a little bit of strength behind it and momentum. And then on the Treasury side, the 10-year yield has come down since its recent high on June 14th to when it was just under 3, and now it's just under 3.5%. So does that indicate that we've maybe reached a little bit of a turning point here, because we're always looking at that inverse relationship between Treasury yields and equity markets, and it seems like they're actually going in that inverse relationship now?
Well, yes. I mean, you basically have just spelled out the relationship, but that relationship seems to be quite mercurial, right? Because it's been very data-driven, and it almost seems to change day to day. So coming into this week, especially after we saw all the earnings, we saw the yields fall, we saw the long bonds rally, and that was in conjunction not just with the S&P, but also growth stocks that did very, very well, because obviously they're going to enjoy lower yields. But then it's almost like, well, today we had Fed Evans talking, and a couple of other Fed speak saying, well, wait a minute. That's not really what we want happening. We don't really care about the weaker economic statistics. We still see inflation as an issue. And the yields have actually gone up now a little bit. And you can see the stress in the S&P as a result. And that's where the delicate dance really is, because if yields drop, this is why I say monetary policy for the Federal Reserve during right now in this macro environment is so tough, because if they are too dovish or too soft, then of course they run the risk of the inflationary factors, which are still very much out there, including, as you mentioned before, wages, but also the geopolitics and also just the scarcity still of raw materials in many instances. And then if they go too tight, of course, then they have the result of possibly driving us really into not just a technical recession, but a recession that everyone will agree on. And on top of that, if China-Taiwan doesn't turn into a horrible situation, I'm hearing rumors that there's potential of civil war in Iraq. And of course, even though we've gotten desensitized to Russia-Ukraine, that's still out there. And then, you put that all together, it's tough. It's tough for everybody. It's tough for the Fed. It's tough for investors. But if you just look at price right now, it's okay to be long as you're nimble.
Right. And it's a really good point that you make, Michelle. There is so much that's unknown out there. And that actually begs the question, is this where this lingering volatility is coming from? Are the catalysts what you mentioned? Is it the Ukraine war? Is it the potential of something going on in China? Is it something that's happening in Iraq? Is it just the continued inflation? Prices at the pump are fluctuating, but still way higher than most Americans would like to pay for gasoline. Are those the catalysts we're talking about here for this vol?
Well, yeah, just take Nancy Pelosi, for example. The market held its breath while she was flying into Taiwan. Then the market rallied on some sigh of relief that she actually made it without her plane being exploded in midair, as was threatened. Now, of course, the market's holding its breath to see what happens with China, because they've been very, very demonstrative in terms of military activity, but yet at the same time, the last time historically we were in this situation was when Newt Gingrich went in 1996 under the Clinton administration, and America showed its military might, China backed down. So that's, just to have that type of nerve-wracking environment on a day-to-day basis on top of all the other factors is definitely going to, I think, keep volatility going here for a while. So you've got to kind of trade with that mindset.
Mm-hmm. Yeah, keep your seatbelts on. It's going to be a little bit bumpy for a while, right? So as we're wrapping up here, Michelle, yeah, and that, and this is something that we sure should be getting used to since the start of the pandemic in early 2020. But here it is still. People are still nervous about the volatility. But so as we're wrapping up, let me ask you, because I always like to end with you on this, is where you're seeing opportunities. Now, let's put it out there. We've got a 10-year yield at a 263, 260. We've got an inverted yield curve. The 2s and the 10s are inverted, which, of course, does kind of indicate recessionary momentum. But on top of that, we've got all this volatility and the unknowns that you were just talking about. So without mentioning maybe single stocks and more from a sector perspective, where do you see opportunities right now for investors?
Obviously, climate change has been something that we're now looking at potential legislation on. So I really like some of the solar areas, but also running very rich. So I'd like to see some of that come back down. And then otherwise, I think having a little bit of a position in the precious metals, particularly gold, with all these factors all around is probably not a bad idea. But otherwise, biotechnology has been kind of going sideways, but it could be a good defensive play along with some staples, consumer staples. And also, interestingly enough, is we are getting more and more legislation and talk on the cannabis industry. So we've been looking a little bit at that. We're flat because we've seen too many rallies peter out. But, we're always checking out there. But I would also, like I said, even oil. Oil has been struggling here, but if we get the oil through $110 a barrel, I think that's going to probably tell you a whole different story, which is get into commodities, get out of equities, and watch that oil soar, because it means there's been trouble, more so than we already have globally.
Terrific. Michelle, always great to have you join us and get your insights. Good to see you. Michelle Snyder from MarketGauge.com, Managing Director there. Michelle, thank you. And for more